Imagine a financial invention so clever, it promised to make banking totally safe, a kind of insurance policy that could just erase the biggest risk any lender has to face. But what if that safety net was really a trap, one that was about to bring the entire global economy crashing down? Well, that's the wild story of credit derivatives.
All right, so how did we get here? Here's our game plan. We're going to start with the basic risk of just making a loan. Then we'll look at the genius, and I mean genius, idea for insuring that loan. From there, we'll see how that insurance morphed into a massive global casino. And then, what happens when the house can't pay its debts? Finally, we'll get to the heart of it, the new rulebook designed to stop this from ever happening again. So first things first, before you can really get your head around the solution, you've got to understand the problem. And for anyone who lends money, this problem is as old as money itself. It all boils down to something called credit risk. It's really just the simple nagging possibility that if you lend someone money, you might not get it back. Every single loan, whether it's on your credit card or a giant corporate bond, has this risk baked right in. It is the central challenge of finance. So, facing this constant threat, Wall Street did what it does best. It engineered a product, a really clever way to take that risk off your own books and sell it to someone else who was willing to take it on. And they called it a credit default swap, or CDS. Now, I know the name sounds super complicated, but the idea behind it was beautifully simple. Just think of it like an insurance policy for a loan. A bank pays a small, regular fee, a premium, to another company. And if that loan ever goes bad, boom, that other company pays the bank back in full. The risk is just gone. Problem solved, right? Well, not exactly. And on paper, the theory was perfect. Bank A can make a loan safe by paying a premium to Bank B. And Bank B? Well, they get to collect that steady income for taking on the risk. It looks like a total win-win, a way to make the whole system stronger by spreading the risk around. But here's where everything took a massive turn. See, these CDS contracts didn't just stay as quiet little insurance deals between two parties. Nope, they got bundled together into these big indexes, and all of a sudden, they started trading on the open market just like stocks. The tool that was made to manage risk had turned into a way to bet on. And of course, once you have a new market like that, it needs more stuff to trade. So, the next logical step was to take the actual loans themselves, package them up, and sell them off in little pieces. This is where you get things like the CDO, the collateralized debt obligation. The concept was kind of like making a giant financial smoothie. You take thousands of different mortgages, car loans, credit card debts. You throw them all into a blender, mix them all up, and then you pour that mix into glasses to sell to investors all over the world. And boy, was the world thirsty. This market for bundled up loans didn't just get big, it went absolutely supernova. Just look at the growth. In only 6 years, the amount of new mortgage-backed securities being churned out each year exploded by more than 600%. It was a tidal wave of debt being created, packaged, and sold. But this whole incredibly complex machine, all the loans, the securities, the insurance, it all had a single fatal flaw that pretty much everyone was ignoring. In all of this excitement, they forgot to ask the most important question of all. What happens if the insurance company itself goes broke? This is what we call counterparty credit risk. It's the terrifying danger that the very institution you pay to protect you simply can't pay up when the crisis hits and you need that money the most. And in 2008, when the US housing market started to completely fall apart, the world got its answer. And it was terrifying. Suddenly, all these loans were defaulting, which meant all those insurance policies were getting triggered at the same time. Everyone turned to their insurer demanding to be paid. What you're looking at here represents pure, unadulterated fear. The TED spread, it basically measures trust in the banking system. And that massive spike in 2008, that shows that trust didn't just get weaker, it completely vanished. Poof, gone. Nobody knew who was solvent and who was about to go under, so the lending that keeps our entire economy moving just stopped. This wasn't just a US problem. The panic went global. All of a sudden, it became incredibly expensive to buy insurance on even the safest things imaginable, like German government bonds. And you have to ask, why? Because no one trusted that the companies selling the insurance would even be around to pay the claim. That right there is counterparty credit risk in action. It's a crisis of faith that can freeze the entire financial system solid. The 2008 crisis was, and this is not an exaggeration, a near-death experience for the global economy. In the aftermath, regulators around the world had one single mission: fix the flaw. drag this thing called counterparty risk out of the shadows, and force banks to actually deal with it.
And their main response was a massive new set of global banking rules known as Basel III. This was a complete overhaul, but a huge piece of it was a direct assault on the very problem that caused the crisis. The goal was to stop letting banks just cross their fingers and hope their partners were safe. The new goal was to make them prove it, and to make them pay for taking on that risk.
Now, a key weapon in this new regulatory arsenal is something called the Credit Valuation Adjustment, or CVA. And this isn't just some boring accounting rule. This thing has teeth. It forces banks to calculate the exact amount of money they could lose if their trading partner defaults. And then, and this is the most important part, they have to set aside real cash, actual capital, to cover that potential loss.
And this is where the rubber really meets the road. This shows you how that CVA rule works in the real world. So if you're a bank and you do a deal with a super safe AAA-rated partner, the capital charge is tiny, less than 1%. But if you decide to get into business with a much riskier CCC-rated firm, the regulators make you set aside over 14 times more capital. All of a sudden, choosing a shaky partner isn't just a gamble, it's incredibly expensive. And that really brings us to today. The financial system is, without a doubt, much more resilient than it was. Counterparty risk is no longer some hidden monster in the closet. But these new rules are incredibly complex, and, they were designed to prevent another 2008. So the ultimate question we're left with is this. Have we really built a safer system for the future? Or have we just built a really elaborate fortress designed to fight the last war?